Well, welcome Investorholics and friends to another ETF Spotlight review. Today we'll be looking at HBRD, which is the BetaShares Active Australia Hybrids Fund. This one's a managed fund. So debt plus equity securities equals hybrid securities. So what are hybrids? Hybrid securities are securities that contain elements of debt and equity securities. Like bonds and shares, hybrids are a way of companies to raise capital to fund their business. By issuing hybrids, companies effectively borrow money from investors in return for interest or income payments. So hybrids can be expected to produce risk and return characteristics above those of traditional fixed income securities like bonds, but below those of ordinary shares. So that's kind of in the middle, I suppose. So HBRD gives the investor the opportunity to earn attractive tax-effective monthly income from a diversified portfolio of hybrid securities, actively managed with the aim to reduce the volatility and risk associated with owning hybrids. If you own them directly, there's quite a bit of risk and knowledge around those. So if you're interested in learning more about a different type of security or a different type of way to earn some income, hang around. This will be a very interesting little video. Well, hello there, Investorholics. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your own personal finances, expand your investment horizons, and crack your financial sky. Okie dokie, so HBRD aims to provide investors with attractive income returns from the actively managed diversified portfolio of primarily hybrid securities. As you know, we've kind of touched before, the fund is actively managed. So HBRD will invest in an actively managed portfolio of hybrid securities overseen by a professional investment manager. If the hybrids market is assessed to be overvalued or to present a heightened risk of capital loss, the fund can allocate more to the portfolio to lower risk securities such as cash or bonds. The fund's investment manager is Coolabah Capital Institutional Investments, a bit of a tongue twister, but CCI for short. So CCI is an independent Australian active fixed income specialist with expertise in valuing, analysing and investing in hybrid securities. So it sounds like they know what they're doing. So why would you bother? This one is professionally managed, as we said. So it gives convenient exposure to diversified portfolio of hybrids, which seeks to reduce the potential downside risk of directly holding individual hybrid investments. Attractive tax effective income, and you get a payment monthly, which is good. So hybrid pays income monthly at a rate expected to be significantly higher than the cash and senior bonds, along with your franking credits. So you get some franking credits as well. So it's actively managed, as we mentioned, by a fixed income specialist. It targets low volatility and reduced risk. Fund can increase exposure to cash and bonds if required, given conditions, in order to reduce the risk, as we kind of touched on just before. But definitely having an active manager as opposed to an index can be useful at times. So I had a net asset value of $10.01, trading at the net asset value of $10.01, market cap of $719 million, management cost 0.55%, but there's also a performance fee in this one, which is 15.5% above the benchmark. The benchmark for this one is the Sol Active Australian Hybrid Securities Index. As we mentioned before, your payment will be monthly. Dividend yields roughly 3.2% or thereabouts, as far as I can ascertain or work it out. So compared to traditional bonds and equity investments, hybrids are relatively more complex, so securities complex securities to understand effectively and value, and trading in these type of securities is relatively less liquid, just because the market for retail investors is a little bit difficult. If the investor is interested in these type of strategies, then it would probably make sense for them to gain exposure to the unique risk and return features of hybrids through professional manager. That's kind of why I was reviewing this one, because it's actively managed. Something different, gives a different opportunity to earn some income. But personally, I'm not experienced in using these type of instruments. So, I would advocate, or, for myself, if I was going to look at this one a bit further, you want to do some more research on how the whole hybrid thing works to make sure you can actually understand the background and how everything works. So most of that sort of information can be found in the flyers, which are in the comments. And also you want to go through and read the PDS and do some more research on hybrids. Hybrids are unique in that they are both bond and equity features. So they have both bond and equity features, as we've kind of touched on before. So they provide a unique diversification opportunity to investors along a risk-return investment spectrum. So they're kind of in the middle between bonds and shares. Hybrids are quite possibly a niche strategy, unsuitable for the average investor. I would advise caution, but if you've done your research and you think you understand how it all works, then by all means have a crack at it. I'm not sure if there's actually any other options on the ASX at the moment for hybrids, but you probably want to do a bit more research just to dig that out. I didn't have time. It wasn't actually that straightforward to find sort of an equivalent ETF on the market to do some further research against. So definitely have a look at this space and do some more research on the other alternatives as well. So I didn't know much about hybrids before researching this video. Apparently they're actually quite popular with Australian investors. I didn't know that. So the main reason being that they offer attractive franked income returns for usually only a moderate level of volatility, as when you sort of weigh it all up. And many carry the creditworthiness of being some of the most favourable and prudentially sound banks in the world. So you can have a look here on the right hand side. Pretty much just all Westpac, ANZ and Commonwealth Bank, the top 10 holdings in the portfolio. I suppose they have a valid place in the market. When you look at the risk-reward spectrum, they kind of sit sort of in the middle ground. And they're definitely an interesting way to get some dividend income if you're looking for more dividend income. So they've, as we kind of looked at before, they've sort of historically only been returning roughly 3.25% since inception. So that's capital growth anyway. But you can see on the right-hand side here, went quite heavily negative in the coronavirus crash, but it's sort of been able to come back up a bit. But really, if you're in this, you're sort of in it for the monthly returns, I would have thought anyway. So you're getting a little bit over 3% return per month, better than the banks. Not as good as some dividend stocks on the ASX, but it's definitely another alternative to getting some income. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's KrackTheSky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.